Hello, my name is Gloria Guzman, and I'm an Outreach Senior Advisor with the Federal Reserve Bank of Atlanta in the Miami branch. The views expressed here are those of the presenter and not necessarily reflect those of the Federal Reserve Bank of Atlanta or the Federal Reserve System. This presentation is about savings and the role of government. The primary federal supervisor of a domestic bank is generally determined by two key factors. One, whether the bank chooses to operate under a federal or state charter, meaning a business license. And number two, the governmental authority, federal or state, that grants its permission to commence business operations. Banks that are chartered by a state government are referred as state banks, and they are licensed to conduct business in a specific state. Banks that are chartered by the OCC, which is an independent bureau of the U.S. Department of Treasury, are referred to as national banks. And those are banks that are given a license, granted a license to conduct business in the country nationally. Regulation and supervision. Regulation is the writing of the rules, the laws, policies, procedures that a financial institution must adhere to. Supervision refers to the examination of the compliance to those laws and regulations by the financial institutions. Nationally chartered banks, Federal Savings Association, and operating subsidiaries of national banks and Federal Savings Associations are regulated by the Office of the Comptroller of the Currency, or OCC. State chartered banks are regulated and supervised by two agencies, usually a federal agency such as the FDIC and the Federal Reserve Board. The other supervisory body for the state chartered banks is the specific state's regulatory body. The Federal Deposit Insurance or the FDIC insures all state charter banks that are non-members of the Federal Reserve System. The FDIC also insures deposits in banks and Federal Savings Associations in the event of bank failure. The Federal Reserve Board supervises state charter member banks, state banks that are by choice members of the Federal Reserve System. As I mentioned before, all state banks are also supervised by the state banking regulators. All of the regulators and supervisory agencies have as mission to ensure the safety and soundness of the banking institutions, and make sure that they invest in communities that are underserviced. They protect consumer rights and provide protection for consumers. They educate consumers and provide consumer information. They ensure that consumers have fair access to financial products, and specifically the Consumer Financial Protection Bureau, or CFPB, enforces federal consumer financial laws. Here's a pie chart of the different entities that the Federal Reserve oversees. The largest part that you can see is our bank holding companies. These are companies that control one or more banks, but does not necessarily engage in banking itself. The other one that you may not be familiar with is an Edge Act and Agreement Corporation, and these are subsidiaries of banks or bank holding companies organized to allow international banking on, or financial businesses. The third one that you may not be familiar with are called FMUs, or designated financial market utilities. These are multilateral systems that provide the essential infrastructure for transferring, clearing, and settling payments, securities, and other financial transactions amongst financial institutions. The Federal Reserve supervises these, including certain ones that have been designated systemically important by the Financial Stability Oversight Council. So following on the supervision portion of our regulation and supervision, here is how depository institutions and bank holding companies or saving and loans holding companies get supervised. They get examined by bank examiners, whether they're coming from the OCC, the FDIC, the state banking regulator, or the Federal Reserve. Depository institution, which are the ones that we are familiar with, where you bank, get examined and under the CAMELS system. CAMEL stands for capital adequacy. For example, does the bank have enough money to loan? How is the equity of the bank? Asset quality, what is the quality of its assets that's holding? Management adequacy, is management acting ethically? Is management effective to control risk while being profitable? Earnings refers to earnings health and sustainability. Is the bank profitable enough to build up capital to continue to grow? Are bad investments and loans creating losses and affecting capital? The L stands for liquidity. Does the bank have access to cash to adequate levels to be able to fulfill its obligation, such as honoring withdrawals of depositors as needed? And then S stands for sensitivity to market risk. Is the bank's balance sheet well structured with its asset price in a way that results in profits? Or are the liabilities priced at a higher rate, which could result in losses for the bank? The bank holding companies and savings and loan holding companies also are subject to CAMELS, but in addition to that, they also get examined under risk management, financial condition, potential impact of the parent company, the consolidated composite condition of the institution. So they are subject to even more examinations because they're being held by another company. So you have to take those into consideration. Here we have a slide with additional information regarding the OCC and the FDIC. As you see, the OCC issues licenses for nationally banks or Federal Savings Association. They ensure safe and soundness of its operations, provide fair access to financial services, ensures fair treatment for all, and make sure that it complies with laws and regulation through the process of examination. The FDIC does not grant charters, but they ensure, examines receivership. So for example, when a bank fails, the FDIC is the one that takes over and decides what to do with its assets. They maintain stability and confidence on the financial system by providing that peace of mind, that insurance. of deposits, and they also examine and supervise state banks that are non-Federal Reserve System members. This is an illustration of the financial industry and who regulates and oversees it and examines them. The primary supervisor of a domestic banking organization, as I mentioned at the beginning of the presentation, is determined by the type of the institution as well as what type of charter and who issued the charter. So you have here with the khaki color, the green color being the Federal Reserve. And as you can see, the Federal Reserve has a large portion of the financial industry for regulation and supervision. The FDIC is the orange one, and you see the state charter non-member, as well as non-member savings and loan state charter institutions. The credit unions, the federal credit unions are supervised by the NCUA, which we will be looking at briefly next. The National Credit Union Administration is a government agency and is the one that, through regulation and supervision, provides the safe and soundness of credit union system. They also handle conservatory. So when the credit union gets into problems, the NCUA is the one that takes charge. The last of the regulating agencies that I'll talk about is the Consumer Financial Protection Bureau. This is the newest regulators created by the Dodd-Frank Act passed in 2010 that came about from the latest financial crisis. This one is different than the others in that it focuses on consumer protection. So they do this by eliminating unfair and abusive practices. They take consumer complaints. They conduct research on the experience that the consumer has and publishes its finding in ways that it can educate both financial institutions as well as enhance financial education to consumers. They enforce federal consumer financial laws as well as monitor financial markets for new risks to consumers. Other type of risks that regulators look for and examine to protect us are money laundering. So under the Bank Secrecy Act, the anti-money laundering was established, and they need to ensure that our banking system is not used by organized crime to funnel funds. The most threatening risk to our financial markets nowadays is the cybersecurity. So the information technology and information security is incredibly crucial for the regulators to be on top of and examining for this. We must make sure that the bank's technology infrastructure is safe and sound. So in every bank examination, this component is one of the most crucial ones in order to ensure the safe and soundness of the institutions we use. If you would like to know more about the supervision and regulation from the Federal Reserve, here is a hyperlink that you can use in your class with your students. So after the last financial crisis, regulators realized that they were something like what happened in 9/11 with the defense agencies, where they each did their own investigations, but they didn't really communicate. Well, they realized that happened during the financial crisis. So as a result of that, they created the FSOC, or the Financial Stability Oversight Council. And as you can see here on this chart, you have all the different components that make up this council, and it is the major regulators as well as other government representation. So the government wants us to save. This will, if the citizens have a healthy savings, we will represent less of a burden to the government safety net programs. It would also increase the standard of living. So they create incentives and disincentives for people to save through tax or fiscal policies, as well as other programs that they create, such as your individual retirement accounts or Roth IRAs, as well as savings for specific purposes, such as educational savings accounts. So why should we save? Savings enables investment that enables production of capital goods, which creates economic growth. So with economic growth, the standard of living improvements come along. So if government entices us to save and to save for a specific period of our lives or specific purpose, then we will be less of a burden for the government in their safety net programs. Let's take a look about on fiscal monetary policies and how it affects savings. So fiscal policies are enacted by Congress and signed into law by the president. They deal with taxes or specific programs geared towards savings, whether it's an individual retirement account or an educational purpose program. A tax penalty for early withdrawal of your money put aside for retirement is a decentive for you to use your savings ahead of your retirement account, time. Tax deferred is an incentive given to us by Congress so that at this time the money is taken out of our taxable income and put aside on a retirement account for us to use and take out once we retire. This does two things. One is decreases how much taxes we're going to pay now because our taxable income has been reduced by the money that I put away on my savings or retirement account. And two, it's going to benefit us in the future when we are retired and take out that money. Because at that time of retirement, it is most likely that our tax bracket is going to be lower than at the present time when we're earning our salary and our wages. Now, monetary policy is enacted by the Federal Reserve, and it is not geared towards savings or non-savings. What effect it has on savings is actually the other side of the coin or an externality from what its purpose of federal fund rate is. Federal fund is targeting the interest rates that are chargeable by financial institutions for lending money out. This is a way to fuel the economy during sluggish times. So like right now, our economy is trying to recover from the pandemic. And the pandemic, although it's not an economic crisis, has created an economic crisis. And so the interest rates remain low, so to entice institutions and people to borrow money, therefore creating movement in the economy and trying to fuel it. But the other side of the coin is that interest rates that are available for institutions to charge remain low. So institutions use the money that we keep in their banks, in their business, to lend out. It's the same money. And if they cannot charge too much for the loans they make, they cannot pay us um, a lot of interest on the money that we keep in their banks. So what we get paid in our savings accounts at the moment is very, very low. As a general rule, how much savings should you have or should you put away um, at different age stages of your life? And here is an example. At age 67, which would be most likely the retirement age for most of us, you should have in your savings 8 times your last annual earnings for you to have a comfortable and healthy savings. This is a really good video regarding growing money and compound interest and the importance of compounding interest and starting as early as possible. I highly recommend you checking it out and use it in your classes with your students. These are examples of government incentives for you to save money for a specific purpose, in this case for education. In addition to the government creating and providing incentives or disincentives to save, your employer may also have programs that you may or may not be familiar with. But if you're not, it is a very prudent and recommendable thing for you to look into. For example, 401ks are retirement accounts that are offered to employees by employers, right? There are also matching. So in the 401k, for example, the Federal Reserve matches up to a certain percent of my pre-tax contributions to my 401k. What does that mean? That's an incentive for me to, at a minimum, do that percentage of money put away for my retirement. Otherwise, I would be leaving money on the table because they are giving me $1 for every dollar that I put in up to the percentage they allow. They also work under the limitations of the IRS. So through the IRS taxing fiscal policy, the government provides the employers to match funds up to a certain percentage. The 403B would be the retirement account that you as educators have available to you. They also have other employers' benefits, such as your flexible spending account or your health savings account. Those are pretty much reimbursable to you for expenses that you know that you will have for different things throughout the year. Here is a comparison between a 401k and a 403b. They're both contribution plans, but they're just available to different types of businesses or corporations. Here's more information on those additional benefits with incentives for savings for expenses that you know are going to be incurring throughout the year. No Frills Money Skills is a series of videos that are from our St. Louis Fed website. This one specifically is on different ways of savings, and it is set up as a game show. I highly recommend it for you to check it out and to use it with your students in the classroom. And this concludes our presentation on savings and the role of government.